who is really kind of a legend in the crypto space. He's traveled for the last 6 years all over the world and started amazing conferences and supported many different companies and just is very loved and known. To do this together, to bring back BitAngels network to Texas and to empower entrepreneurs and other investors to look at this industry, to support it. It is a network of over 10,000 investors. So we will be moving forward. In our future meetups, we will have a mix of presentations from investors as well as entrepreneurs and tech companies. So if you do have a company that you would like to see that you could launch here, please let us know. We would love to be able to look at your pitch, see how we can help you to actually launch it through our network. But without further ado, I would like to introduce you guys to our panelists. It's Matt McKibben. He's a founder of Decentranet. Christopher Calicott, he is a managing partner of Trammell Venture Partners, and Justin Litchfield, he is a partner of ProChain Capital and technical VP of ABE, the Global Securities Exchange. So today I would like to kind of think of the discussions in two perspectives. Let's keep two perspectives in our mind. Number one is what is that an entrepreneur must keep in mind when they're pitching to an investor, to crypto investor. And then as well as if you're an investor, what are the things that you should consider when you're investing? And if you're not investing yet, what are the kind of first steps you must take in order to make that shift? And so before I would like for you to know our panelists, and so I would love to start with Christopher. He is just really an amazing, brilliant person, and he does a lot of work here in Austin, and in Texas through Capital Factory and other accelerators. Besides doing work in supporting very important technical companies in providing funds for them for seed and early stage investments, he always dedicates his time and works with entrepreneurs. I believe that there are a couple of you here that he actually has worked with because some people came up and said that. So if you would like to be able to see if Christopher's fund would consider investing in your company, he would be a great person to take you through the path. Matt McKibben here is, like I said, very beloved in the crypto industry. He got into space in 2013, and he was one of people investing in Bitcoin, and he was one of the first people investing in BitAngels network. And remember that this network gave life to many different alternative currencies that we know now. And so he's done investments from cryptocurrencies to ICOs and to all kinds of mixed theses from all over the world throughout years. Justin Litchfield is a partner at a ProChain Capital. It's a crypto fund out of New York. So I guess now I would like to ask Chris about kind of your perspective on what do you think is the number one thing a tech company should think about when they thinking about maybe doing something with blockchain or implementing blockchain? Would it hurt their company that if they invest their kind of a technological thesis?
This answer might be a little surprising, given the audience. I think we're all sort of believers in the power of distributed ledger tech. I always kind of go through this process where I'm trying to understand why it is that someone really truly has conviction that that is the solution to the problem they're solving. I find personally that large problems that are on a very, very large scale to be solved are typically the best fit. Enterprise solutions have struggled because of the need to do things like find people to run nodes. And sometimes those people might be competitors. And probably more importantly and immediate for an enterprise, it's not in their core competency to go out and kind of build these fundamentally decentralized sort of networks and get people to operate nodes. It's just not in their business. So it's a little too far afield. So I think it's important to understand why you're making that choice. Distributed ledger tech is a basket of tools that may very well be a great fit for what you're doing, but it tends, in my view, to correlate with scale, massive problems, and it might not be the right solution. So I think you need to, at a minimum, be able to articulate exactly why that's the case, and I would encourage you to sort of get with technologists that have done a little bit of investment in the space and just riff with them and talk, think aloud. I like to talk aloud. That's just kind of my process, and land on why you think that is. And the answer, it's okay if the answer is it's not a fit, but if it is, great.
Yeah, absolutely. So that question was related to a technical application, and I 100% agree with you that it's still, we kind of keep coming to this, how does it work at scale? There are other ways that crypto can change a company, and it would be an investment in, let's say, a token form. And so, Matt, that brings my question to you. If you're a company that is considering tokenized raise, what are the safe ways of going about it? And, a quick summary of what you think.
Yeah. Well, that space has changed a lot over the past 3-4 years. Like, so in the beginning, there was this, the main concept is you're pre-selling access to an open source software system where lots of people will be able to collaborate and use these mostly essentially credits to your software utility. And that was the main point when all of this kind of started. It became kind of crazed in the ICO boom, and they even changed the term from a token sale to a initial coin offering, which made it sound a lot more like a security, which the SEC still could come back. And now, like, ICOs in selling that kind of thing in the United States is pretty much dead as far as I can see it. If you are going to be selling a token, a lot of the rest of the world, they're still kind of happening, but more in a form of an initial exchange offering. So instead of doing just an ERC-20 kind of sale on your own website and doing all of that, a lot of them are doing it through the exchange infrastructures, specifically in Asia. It's happening a lot. Using like Binance, for example, using the BNB token and BNB infrastructure to kind of do that. It depends on where you are in the stage. Like, he said, like, why do you even need a blockchain? Why do you need a distributed ledger? Are you trying to allow tons of different, disparate parties to collaborate on an accounting ledger or on a system where they would normally have siloed information and not be able to do that? And then if you are going to actually have a token, if determining like what its utility is, why would people actually be purchasing this other than speculative asset? Are you going to be doing like an equity raise with that? I would say that most of the United States kind of sophisticated investors wouldn't be just purchasing tokens. They'd be doing some sort of equity raise, and maybe there's a token option, but it would be accredited investors. And then you considering the kind of like Reg D or Reg CF or Reg A plus kind of new forms of the Jobs Act, and figuring out which one might apply for how you're going to be raising, especially if it's so like I think Blockstack is doing theirs right now, and that was under a Reg A plus. Okay, all right, everyone knows. I'm just making sure. Yeah, and so like figuring out those different methodologies for that, it'll be interesting to see whether that token, ever becomes a utility token afterwards and they launch it, because you'll have to get a designation, I believe, after the SEC will have to come and say, okay, this is officially no longer a security. And so following those rule sets is really important here in the U.S. and Asia. It's a little bit different, but you would have to go really get involved in the groups of investors and promotions and figuring out that, which can cost a lot of money and resources and network to go and do that raise versus doing it in the under the regulated
Yeah.
methodologies.
Yeah, and I think that that really kind of summarizes it, that if you are, if you are going to be considering and going and doing that, remember it is very expensive, and it still includes a lot of unknowns. So in my opinion, if you are an American company, go through traditional fundraising, and once you can actually have a product, once you can scale, going to Asia and actually really be able to support the network, then look at other things that will be available for you then. But for now, be conservative.
I would agree.
Yeah.
Yeah.
And so that really brings me to kind of a next natural question, and that's tokenized securities. And Justin, that is a question for you, because you are building tokenized securities, global tokenized securities exchange, global securities exchange that also is building a pathway for tokenized securities. So can you expand on kind of what is the state of events right now in the global market for that?
That's a great question. So we went through the kind of ICO boom, and we and before that, right? People came up with this idea that blockchain's cool, ledgers are great ways to keep tracks of who owns what, and a very natural thing, So Bitcoin came out, and then people started tracking other sorts of things, other sorts of digital assets. And then we had Ethereum, and then people are like, well, we can do all sorts of things that are just like securities. And these big ledgers are great for tracking things like securities. And then people just started selling securities using blockchain because it was a new technology. And so the rules didn't apply to them, I guess. And so that was a total mess in 2017. It was a very exciting time, and a lot of people made a lot of money, and a lot of people lost a lot of money. And there was a lot of churn through the ecosystem and creative destruction, and that was really, it was really cool to watch. It was really fun. And now we're kind of coming back to this period of like, okay, like the security infrastructure works. It does work great for securities, and there's some really cool things that we can do with distributed ledger technologies around securities that we can't do in the kind of traditional infrastructure. And almost all of that has to do with just the transnational nature of the world. Like the world is shrinking, the world is getting smaller. So much more of these concerns go across country lines, and securities laws, securities infrastructure, like all the legislation has been very, very nationalized. It's very localized, and so for any kind of security to operate in any more than one jurisdiction has been very, very challenging. Like if we just kind of take the country out of this solution, out of this whole equation, that gets a lot simpler in some regards. The problem is, of course, every country has people. They want to protect the people, kind of. And then there's but there's more importantly, there's the regulators, and they want to protect their regulatory purview. They want to say like, hey, like we are doing an important job here. We're protecting investors in our country. You can't just go start doing something and selling things to people in our country because the rules don't apply to you. These are my rules. I made them. And so it's a fine line to walk. Like this technology does work. It works like across borders. It works globally, in a way that was really incredible to watch, and it kind of happened naturally. We've had so many times in the past, there's been so many promises for the last, since we digitized securities in the 60s. It all got digitized in the 60s, by the way. So we digitized securities in the 60s, and then people were like, let's start doing this internationally. And there have been billions and billions of millions of dollars spent in World Bank study groups to get together big consortia to try to make an international settlement or an international securities network, and nothing came of it. And then we had an ICO boom, and it just worked, right? The infrastructure kind of works, it's there. And it was kind of an emergent thing. And now we're kind of in a state where we've seen that technology can work. The regulators saw it happen too, and they know that there's going to be a change. And we've seen a lot of adoption from them, and they're really eager to get on board and say like, okay, we know that not all of the old laws will carry over. We know that something's going to change, but they want to have a voice in the process. And we've actually had a lot of success with the securities exchange I'm working with, going and very actively talking to the SEC, talking to the EU, and talking to the Asian, Singapore, Hong Kong regulators, and very active discussions and getting the licensure and saying like, hey guys, we've got a path that can kind of make this work. Like these things will all settle very elegantly. You can control some part of what your citizens see, and that's really nice. But we're going to be working to add more features, make these systems better kind of under the hood. And so it's starting to come along. It's a lot of work because the regulators are slow. Securities laws have a lot of inertia. We've learned in very hard ways that they're important. And so it's happening though. It's hard to really look and point at progress. It's not an incremental thing.
It's not a speedy process as some might consider and hope, but it is progressing, and it's progressing throughout the world. And so I would like to now, I really thank you guys for the three perspectives. I would like to now talk about kind of a reality of, let's say that, okay, well, so now you're an investor and you are holding these crypto assets. Chris, I would like to know from your perspective, how do we even evaluate these crypto assets in our portfolios, and how do we categorize them? Because we have cryptocurrencies, we have tokens, we have, how do we even look at the equity company that actually holds the tokens, right? What are these networks are?
This is a fun question for me because we have this problem at work in a very meaningful way in a couple different contexts. So I'll answer your question specifically about a portfolio company that might have some digital assets on their balance sheet. If this is there's a paradigm here, you know, you can market to a market somewhere. So kind of a mouthful, you know, but you have to choose a certain timeline. There's much more volatility in these assets, of course, than traditional ones. So, you know, in terms of a portfolio company, I tend to look at all of the other details other than this one asset that might be on the balance sheet. For me, that's not necessarily value created if they didn't create the network, the protocol, or whatever it is that's driving the value of the underlying asset. If so, then that's kind of a different story. I think in the future, though, this is going to be a real meaningful problem that all VCs, family offices, right up the capital stack to pension funds will have to deal with at some point, because more and more as we start to realize the promise of settling transactions with a protocol token that might be minuscule in value individually, but in aggregate is huge, this is going to move the numbers, and it's going to move the numbers all the time right up the capital stack. And so they're going to see a fluctuation in an asset that was historically very illiquid and very permanent. Just kind of the inside baseball for the venture perspective. Typically, you only change the value of an asset after there's another transaction. So let's say we invest $100, and a couple years later there's a Series A, and you know someone else invests $100, but at a completely different valuation. We will mark that asset at what the new price that the market put on it was. This might be a lag of anywhere from months to a couple of years, and that only happens very infrequently. So in general, that's what they're used to seeing. But if you're having to mark something on the reg because it's traded somewhere, then all of a sudden there's a lot of volatility, and it's not the way they understand the asset class venture capital or broadly private equity, or in the future when this starts eventually bubbles up into public capital markets because they need some of these assets to do their day-to-day business functioning. Everyone's going to have to deal with it. So I could answer the question and say how we do it. We just kind of take a historical 12 months and most recent 90-day mean of the asset, It's a real blunt instrument, but it works for the moment. But actually, I think this is an ongoing conversation in the investment community around CFAs, Kaya folks, and lots of other people as well about what do we do. But that's our simple approach.
Yeah, that's amazing. This really kind of now brings me to the question of treasury management. And so, Matt, you have a lot of experience working with the companies that went through number of growth cycles, and especially in the post-ICO, or what was ICO times globally. And I'd love for you to expand on that, and specifically kind of what are the advice you would give in spotting those that have poor treasury management?
Yeah, definitely have invested in plenty of ICOs that have had poor treasury management, and I wouldn't say my treasury management has been the best possible in the world either. Everyone kind of gets really excited when there's a boom, and really, oh man, when there's a bust. Yeah, so if you're going to be having other people invest in you in speculative assets that have a lot of currency risk, you really want to kind of capture that value as soon as possible. You might go up, you're right, it might go up, but it might also go down, and then your runway typically goes down pretty quickly. So like one of our portfolio companies, they raised $13 million. They were out of San Francisco. They raised $13 million in 2017, 2018. And they built a network, they built a protocol, they have people running nodes all over the world, they have tons of partnerships, and they ran out of money because they didn't put all of their assets into a stable coin or a stable thing, and it was actually hard for them to find proper OTC vendors and things that would work to sell. And now they think they just got acquired or acqui-hired by someone else, but the token holders technically, if they're buying the equity, don't really get anything at all. Even though the network and the tokens might be worth something, but they're not being traded anywhere, and they want to make sure they're not a security, so they're building out and make sure they're decentralized first before they actually go and list the token, where they know many of their early investors are just people that want to dump the token immediately. So my advice is always, I mean, there's a number of different stable coins out there now that you could actually still keep it in crypto. That didn't really exist very well. I mean, there was Tether in 2017. And then there's also going to be ones that kind of hedge against, so like I heard about one that's being built now that's kind of it's equal parts kind of bond, like U.S. Treasury bonds, Bitcoin, and gold. So it'll be backed by like kind of three of them, so that like if depending on what your risk is, you invest in this and they'll kind of balance each other. So there's also a lot more kind of algorithmic ones that will adjust the risk as things get more volatile. So yeah, I would just say if you're raising in that asset, if people are giving you Bitcoin or giving you Ethereum and raising, I would put it into dollars and some stable asset immediately, so that you actually have that runway as much as possible. Yeah.
Add to that?
Of course. Yeah, please do. Yeah,
I think
this
we all
is
have
a
opinions
discussion.
here.
Yeah, I'm starting off, and pick it up.
So this is a weird problem, right? So you do an investment in a founder team that you just have high conviction in, and they're building something that's probably pretty technical. There's all sorts of market forces and other kinds of risks that normally should be their area of focus. And from an investment perspective, that's a huge distraction. They got a problem set that you would have only a few years ago never even considered, really, because they're in the asset management business.
Yeah.
They're not actually building anything. They're building something and managing assets, which is a whole set of problems that there's a massive industry around, and they're real problems. If having a lot of something and deploying it appropriately is the people with very sophisticated charters that do that kind of stuff on a regular basis. So it's a really interesting problem, but it's also, and if you're founding a company, that's the way you go. I would say be prepared to have some really interesting discussions around this, because I think now there's the level of sophistication around Treasury has definitely gone up, and you're going to have some smart questions with how you're going to manage this. And it might be something like a stable coin if you're accepting crypto and you want to keep it crypto, something like that. But it's a real set of problems, and for me, it's a real big distraction. If you invest in a team that has a special set of skills and insight to the way that they think the future is going to unfold, and that's what your conviction is, the last thing you want to do is those really smart people to be distracted with this other set of problems.
Yeah. It's interesting because, so there's, on the one hand, you say that these treasury management tools are getting better. And on the other hand, it's kind of not, when I look at it, like, I don't want those people to be solving that problem at all, right? Like, this is, like you were saying, like, this is a completely different task. And I actually saw a number of companies that I was kind of working with and around in 2017 where somebody would raise like $10 million to start a software company. The price of Bitcoin doubled. Now they've got 20. And now they're like, we're just going to run a hedge fund essentially and like bail on the whole software company. And start investing, and like they nominally would hire an engineer or two, but their focus was really like, we're going to start like investing in other companies, like, because this is going to keep doubling.
It was the de facto.
And it was,
yeah.
and that's kind of scary, you know, for a ton of reasons. And
not the least of which being that if you want to invest in a hedge fund,
right,
you'll find someone who's super specialized in that very difficult space.
Right, it's a completely different world of problems. That said, like this whole idea of like giving smart people a bunch of money to build companies to solve technical problems is not new. That didn't start in 2017.
Yeah.
And there are like established like best practices around doing this. And maybe the venture world went too heavy in favor of the investor as opposed to the founder, and that got a little bit skewed. And all of a sudden, like, so my personal view is that. Like the Valley's always given people a lot of money. If you're raising outside of the Valley, it's tough, but the investors have a ton of control of the company. All of a sudden, there became this huge pool of capital where smart and entrepreneurs could go access with almost no strings attached. And so they kind of had this huge flood of money come in, but it was a very unnatural thing. That well is dried up. And for us to be now trying to mitigate the problem of a tiny startup having way too much money is kind of a weird problem set to go after. And so like maybe we should like take like 4 steps back and like start looking at how we can help these founders that maybe were inspired by the cool things that got built in 2017 and like, hey, like you're not going to get $20 million tomorrow, but like what can you do with 500K? You know,
Yeah.
are we seeing more progress on that front?
Democratizing of the ability to raise, you know, globally without borders, that kind of like just have the sway of the pendulum was interesting to see in 2017. And I mean, if you're making, all of a sudden you're making 10, 20, 30x on your money in a couple of weeks, then people kind of go haywire with it.
I think the short answer to your question is yes, that's happening. In fact, and I can't say it's not announced yet, but the first new money investment out of our current fund is a company in this space. They're addressing a very important problem, and eventually there will be a token, and they're raising smaller amounts of money as they need it. They're heads down, very, very smart folks that are building the company, and if they need some more, they're going back to markets, and they're raising it successfully every time.
That's what I really observed that is interesting to me, that even through the what we call winter, crypto winter right now, we see a lot of companies doing great job developing and actually raising reasonable amounts, right? What startups should do, and they're doing the development head down, everything. There's so much development that's happening right now on all kinds of different verticals that is just unknown, right? And to me, that's really empowering.
Follow up there. Have you guys, and this is me just selfishly trying to educate myself more, so I'll take advantage of the time here. Have you guys seen any company, so Matt, you mentioned that company raised 13 million and ran out of money, right? Tons of companies in 2016, 17 raised 13 million and then raised more because they were having traction. right? Have we seen any kind of token companies from that vintage be able to raise any follow-up money?
From like 2014, 2015, or
Sure, any of these like token companies, or was that like tainted?
storage, for example, I mean, I put like a Bitcoin into the storage token sale, which was the token for the distributed storage thing, and they did a second raise actually in like end of 2016 or 2017, and theirs wasn't a security because they were kind of operating, and they were operating out of Germany, I think it was, but they raised like another 20, $30 million from the initial one. I'm sure there's been other ones that have done, but and maybe if they kept a reserve amount of tokens that they could sell again. But I would imagine that if it was in the crypto winter, the price that you'd be selling it at would be a fraction, a small fraction of what you sold it in the original token sale in 2017, when all the valuations were massively inflated, selling tokens, and the values of the networks were massively inflated. They weren't actually like, oh my God, this network is worth $1 billion. No, it's not. So that's what I would say. And they tried to raise again, but there just wasn't any. The one that I had invested in, there wasn't any interest in that at the time. I mean, they have a network. We've been talking to all the people. They were interested in doing an IEO potentially, but then there's the problem with all the early token holders basically just dropping their investment on the exchange as soon as it hits the exchange. And would you do a lock period and lawsuits and all that stuff?
Yeah. Well, and now I would like to kind of pivot our conversation into a bright side of the industry, which is a blockchain technology, because let's look at both sides, and specifically in its integration with other emerging technologies. I know that Chris, you guys heavily invest in blockchain as well as machine learning and cybersecurity. And so why those three? Because there are other kind of innovation. And what kind of integration do you see from them three into a blockchain?
It's part of our. There's a couple questions there.
Yeah,
So
there are.
why
Yeah.
those three? I guess this is part of our investment strategy. So I'm going to be pitching you guys. Well, they share much in common. It's an area that we have expertise in, and I think if you kind of sort of think of like a Venn diagram between things like privacy concerns, which distributed ledger is given to that. Most people agree there's a lot of applications there around personal, individual privacy, self-sovereignty, those kinds of concepts, which dovetails right over into more traditional cybersecurity, understanding those kinds of things. So there's a lot of interplay there. But the second part of your question was, what was the second part of your question?
I'm sorry, my kid asked me a question. What is the integration between them? Kind of, what is that one parallel that unites all of them, you think, to blockchain?
I don't know.
Let's say AI. How does blockchain and AI integrate?
Well, I mean, gosh, so we can just riff on ideas of like an integration that might work in that way. So imagine you're a trader. You're looking for some sort of signal that you can fire trades off, algorithmically speaking. You can monitor, maybe you'd monitor a bunch of wallets and look for certain kinds of movements. Over time, you've seen patterns and using clusters that whenever this happens here, it tends to cause a cascade of other effects that you could trade against.
Yeah. Sounds
simple
great.
example, but
Yeah. Justin, you build, yeah.
Why would you need a blockchain for that?
You wouldn't. The AI is
Did I misunderstand?
No. Well, in that example, the cluster would be analyzing something that would be on
a
the
blockchain. Yeah.
So you're using one to understand more about the other in what is
Different
inherently a
software to
massive
analyze
data
what's
set.
happening. Okay, I'm sorry. I misunderstood.
Oh no, Justin. So you build Algo Trader for your fund. I would like to talk to you about kind of the experience of that and how the whole approach of investing in a fund that is outsourcing their algorithm design kind of on it's a little bit, it seems unrelated, but going, I guess my question is, when somebody invests in a crypto fund and it's an algo trading fund, what, from your perspective, they should ask the fund? Because I do know that some of the people actually hire, let's say, developers from other countries to develop their algorithms for their fund.
Yeah, that's tricky. Largely because it's trust, like kind of anything else. Like when you're making investment decisions, it's a very, very trusting decision. Unless maybe there's ways to prove track records by stamping them into the blockchain or something like that. But then you're trusting that they had that track record and that they have the capacity to scale their system and things like this. I've seen a lot of like more than dubious claims, and a lot of it has to do with risk in general, where people are developing systems. These blockchain markets are just super high volatility markets. Like nobody is surprised by this, and building a system that can perform stellarly for a few weeks or days in one of these like these very, very high vol markets is pretty straightforward. Having a system that can handle Bitcoin like under like the different regimes that it goes through is really, really hard. So a lot of it has to do with it's not like, can I put together a strategy that when I backtest in February of 2018 was fine or great or anything like that. It comes down a lot to knowing how to apply that in general. I don't think that much of that is really unique to blockchain.
Okay.
I think that there's a lot of other aspects of running an algo fund or a fund in general around blockchain that are super unique, but they're kind of incidental risk to the actual process of making money. It's how do I custody this Bitcoin? How do I make sure nobody's going to run off with this Bitcoin? How do I, like what are the checks and balances there that the financial system in general has solved pretty well, for the kind of vanilla finance. But the blockchain world has a bunch of incidental risk. As far as the actual essential risk of investing in these markets, it's just more. Like there's just a lot more risk. So you just tend to run systems. At least I've had the most success running systems that would be that are very conservative. If you were to run it on like the S&P 500, for example.
Yeah.
Because like the nature of the instrument is so volatile, the risk you take is much smaller.
Yeah.
Like
Makes
you make
sense.
smaller bets.
Just kind of give a practical example of what you're talking about, Justin. Know a trader, a small team of traders. They raised a couple $1 million a few years ago. Former JPL person, brilliant, had a couple of actually experiments on the space station, super smart team. And they had a strategy that, with backtesting, had worked great. In theory, it had all worked great. And they deployed capital, and it was working great. This particular strategy used a combination of futures contracts. It was only paying and performing off of alpha. And one of the things that's kind of germane to this space and the limited number of venues to do these sorts of trades is that strategies often work until they don't. And that can happen rapidly and suddenly. So in this particular trader, they were using about 3.5 turns of leverage on their strategy. They were using offshore facilities, venues to do some of their trades, and that was all working fine until November 2018, where over a couple of weeks we had major corrections to the downside, and they came unhedged. And due to the ledger, the entire strategy blew up. So,
Wow.
I come from the fiat world, 40 years trading floor in Chicago, and my partner's algo trading 20 years. The biggest problem we see in crypto is that you cannot deploy capital beyond a small amount outside of the top 10 coins.
can you give me a sense of what scale you're talking about? I think it'd be interesting for people here too.
Okay, so if you're going to go execute, say, a $20 million order, you can't do it at an exchange because you're just going to blow the exchange up unless you have a very sophisticated execution algo that prevents slippage, so you're gonna go out to the market makers. One of the best and most successful market makers is Jump Trading. It's one of the biggest high-speed algo traders out of Chicago, Bill Shepard, and, you know, people that I do know, they're very big in this space. But you end up paying away a discount, or, you know, a premium to get executed. So if you're running a model or a strategy that's gonna trade actively, you can never make it. Because if you're paying 4%, 3% haircut to do a trade, you do 10 trades, you're down 40%.
Are you still in the space currently?
Yeah, I'm very active in this space, but we're just an analysis and portfolio and a bot execution on exchanges for retail type traders.
So yeah, 20 million is still a big trade in this space for sure. It can be done. I think it's a little less of the swings that today. One of our earliest portfolio companies has an OTC desk that handles that. There's a lot of, but this is a very slow transaction. This is not algorithmic. You're talking to a person. You're negotiating.
Think about swing trading,
Yeah.
all right? Just look at the current swing within the last 7 days, all right? So go try to do that. You can do that on the regulated markets. That's the problem because it's non-regulated, right? So there's your problem right there. You can't go buy $1 million in Bitcoin and watch it go up 3% and flip it. Unless you know somebody somewhere
Yeah, OTC transactions, yeah.
and it's all collusion.
Yeah.
Yeah, it's tough. The
It's tough,
transaction
yeah.
costs are super high. Like,
Yeah.
even without the
I'm
slippage, the
talking about
transaction
just-
costs are super
just
high.
making that trade.
And then the counterparty risks are out of control,
I don't
like
care
in this
about that.
market
I'm
compared to
talking
the
about the
regulated
infrastructure.
markets. Right.
You can
Yeah.
sign up on anyone in the world can get on any one of the regulated exchanges like Ameritrade or whatever, right? And you can day trade.
It'll
You
take
can
like
buy
a,
$1 million on margin of whatever, watch it go up or down 3% and flip it in a day. You can't do that, okay? Even what's his name? The guy who runs Warsick Jack, right?
it's quite-
He's selling Bitcoin, and he says himself, I can only, I buy the max.
Liquidity has been, yeah, yeah.
So I think that
It's throttled. My point is that it's throttled. It's throttled in and it's throttled out.
I have to be careful about my answers because
Yeah.
we have an investment in a regulated entity. But I think the short answer is everyone has a different perception of at what scale is
Yeah.
meaningful. And I think a $20 million trade, a single trade, is a significant trade.
It is.
Certainly would be for me. But I think
New York
to
Stock Exchange or the NYSE.
Yeah, but
Right.
a New York Stock Exchange marketplace is $1 trillion, many $1 trillion market.
Right.
We're looking at a $300 billion market here. But my point is
So
this,
scale it down.
the concentration of the $320 billion or so market cap in cryptos, 80% of it is in 3 coins, right? In beginning of 2018, 80% of it was in 12 coins. And so you just, there's no, diversification is such a difficult thing to do if you're gonna try and be an active manager, because there's no liquidity. Now,
Exactly.
I'm not saying that it's anybody's fault, that's just
5%,
the reality of the market.
5% own 95%. That doesn't tell you something?
the diversification, so I've done a lot of studies with this, with lots of coins as we're building our models and everything. And I found that like if you like start going and digging into like the deep shitcoin land, like you will find things that are super volatile, absolutely. But if you can't, but like your portfolio probably shouldn't be taking on even Bitcoin risk, like, or like Ethereum risk. That's probably plenty of vol. And so like, sure, we've got like, we kind of do a little bit of long tail stuff at very small scale by design, looking for, like total home runs, but you're not like, I've never had any success with models that are like churning through like real low volume coins.
I
Yeah.
don't intend to have this go into a trading discussion. I'm more interested in the funding discussion, do's and don'ts, and those kinds of things. But the reality of the marketplace is that it's extremely difficult to put larger amounts of.
Absolutely.
I think I'll just say, in short, I think what you're saying, at maybe a notch or two down in the scale is absolutely doable, and it is being done by a lot of different entities.
Right.
At a proprietary level. I'd love to talk with you offline about it too sometime.
I would like to pivot our conversation back a little bit, and then we'll ask questions. I wanted to talk about kind of venture partners, because venture partners is becoming really popular. I see that often now for the early stage companies, especially in blockchain. I see that a lot, that your investors will want to come in and advise you. And for blockchain industry, it's extremely important because they also bring kind of legacy knowledge and expertise that you can't buy with money, right? So they support you with money, and they support you with expertise. I would like for you, Matt, to expand a little bit more on that, as you guys with Decentranet have been doing a lot of work globally with that, and kind of explain the benefits.
Yeah, and so when we founded this company in, what was it, 2017, there were a million different ICOs and token sales going on, and they all wanted you to be their advisor, and they would offer you 0.25% or 0.5% of the token supply, and the and then the liquidity would happen within a month or two, right, after what you were doing. And that happened for a very short period of time, but you could do that. But being an active, our firm is an advisory investment firm. We like to make small investments, or even if we don't make an investment, if we're just advising and taking like a piece of equity, we like to be very active and helping develop the network that we've built and the connections we've built around the world, and connecting and being super connectors in that, and also helping develop the marketing plan and help work with entrepreneurs in that sense, and not just be a stale here's 50K, good luck kind of thing. And so there's a number of different types of kind of, I guess, almost like a virtual accelerator or virtual incubator models that are out there, and that I think have come from this blockchain space, where there were people that were doing it for their early and quick liquidity, and still really like helping startup founders a lot. And so that's our current model. We have a lot of equity ones now. Obviously, the liquidity takes a lot longer, even if you don't get it.
The good old days.
In the good old days, right? But I think it spawned a lot of people that were built a legacy network in a technology stack that you can't go back and replace. You can't come in now and replace the knowledge and the expertise that being in the industry for 5-6 years has provided, and the relationships as well.
Yeah, and I know, Chris, you are really also kind of hands-on with your portfolio companies. You help a lot, and you dedicate your time instead of kind of being withdrawn. What is the reason behind that? It takes a lot of work.
I would say we're small and have a lot of growing to do as a firm, but in many ways we're pretty traditional venture capital, in the sense that, well, I'll say it this way: there's this idea that's been around for probably a decade now, the unbundling of venture capital, and I think we saw this a lot, over the last 3 or 4 years, where it was like, well, we don't really necessarily need some of these other things besides the capital, but in fact, everyone does, because yeah. So in this idea of unbundling, it's like there are kind of 4 traditional aspects that VCs provide. First, capital, that's clear, but it's largely commoditized these days, especially as large as private markets have become. There's governance. You mentioned that one. That's important. Stewardship of the company from a very top, bird's eye sort of view. There's kind of a services function, which what Matt's talking about, and that might take the form of helping you find a key hire and massaging that conversation and say, look, we believe in this team because we put our money there, and that kind of helps sometimes. And I went out of order, so anyway, other things besides capital. And to your point, I think we're very much that way. And if we want to make sure that we can work with a team and that it's actually value add beyond capital, and I like to spend plenty of time before any investment is really even appropriate, just to make sure that it's collaborative. The way I'm wired is a very Socratic sort of case-based background and mindset, and I like to think through problems. And my approach, and this is also kind of how I'm wired, is just to sort of give, and hopefully that'll add some value, and if it leads to something great, but it's not necessarily an expectation of reciprocity, because I think in the community on the whole, it's really important to share. Maybe I don't have that much value to add to this really interesting project, but for today, I do. And so that's kind of my model. I like to sort of get embedded.
I say the same thing. We always we have a lot of social capital. We always make free intros to people that we think would be interested in the project, regardless of whether we're going to end up working, advising, doing business with them in any way. And so I always say the first one's free, right? But yeah, just making intros to relative people that would be like, oh, I know these 5 people would really be interested in what you're working on, and hopefully maybe we'll develop a relationship over the next a month or whatever, where we end up working together in some capacity.
Well, does anybody have questions? I would like to kind of finish our talk, and then really let's connect afterwards. I would like to kind of bring your attention to a place with where we are now, and I believe that now we are kind of starting to finally see the separation of currencies, cryptocurrencies, and blockchain technologies. And I think that it is very important to understand that. And when we're thinking about technologies, we need to also remember that really kind of there's 2 types that can have effect on your investment. One is permissioned blockchain. Those are usually used by enterprises. They're proprietary, and often they're specifically designed for a specific enterprise. And then there's permissionless, and that's what we know as Ethereum and others. And so when you're going out into the world and you're thinking about applications of whether as an entrepreneur or an investor, think about it, whether it's permissioned or it's permissionless asset or blockchain. And if it is permissionless blockchain that is aiming to provide solutions for big enterprises, think maybe there might not be a great match for that, right? So what are kind of applications that we must keep in mind? And I think that to help you clearly understand that it is permissioned versus permissionless, if it's for enterprise, it will be permissioned blockchain, and everything else permissionless. And from there, I think your exposure kind of clarifies much better. Thank you so much for coming, guys. If you have, if you're an investor, talk to us. We really would like to make sure that we expand the investor network. I think that one of the most important things for other investors and as well for companies is to actually have a proper deal flow. So if your company gets funded by one investor, there's a follow-on investors within a network that can quickly close the deal, and then you can actually deploy your funds for the building applications instead of deploying your funds for raising more funds, right? Which is inevitable. You can't prevent that. It is something that's going to happen. But how can we minimize on kind of that expense? And I do believe that it's through the network. BitAngels is the oldest network in the crypto industry, and me and Matt, we are really driven on expanding it here in Texas and making sure that our Texas companies have ability to go out there and actually compete with the Silicon Valley, compete with the companies in Asia. We have brilliant developers here. We have so many wonderful people that live here, and so we want to make sure that they have foundation. Thank you so much for your time, and I'll see you next time too. Thank you, guys. First Monday of every month, except the Monday on September, because it will be Tuesday because of the holiday that we have. Labor Day weekend. Yes. If you're not going to Burning Man, I'm not going to Burning Man, so I'll be here.